Indeed, we love working with Axie, who are our most effective distributor by a very long way. So thank you very much for your support. So as Alberto says, I used to work for BlackRock for 20 years. I started off my career as an accountant in London, and then I was in the army for 5 years doing something very different. And then I joined a firm called Mercury, which then turned into Merrill, that then turned into BlackRock. So basically 20 years at BlackRock investing in technology companies. And in 2017, I left and I decided or I partnered with a multifamily office to relaunch my strategy for family offices initially, and then for a much broader investor base. And just going to switch to slides. So, that has been relatively successful. The fund's almost 6 years old, and as Alberto said, we were very kindly ranked number one. Well, I was ranked number one in the world for tech investors by Citywire for those first 5 years to the end of March. And I think we may have got the number one spot for to 5 years to the end of 2023 as well. But basically, I'm not here to talk about the fund. I'm here to talk about essentially why has technology been doing so well, and will it continue to do so? How you might want to play that. And then a couple of other questions, things that I think people get wrong. Explosive revenue growth, it's very attractive. Everybody loves it. Is it actually important? Is it a good idea? And do companies need to make profits? Almost a philosophical question, and I have a pretty strong view on that. But let's deal with the main point, which is why has technology been doing well? And it's been doing absolutely incredibly well. So the blue line here is the global technology index, and the grey line is global equities in general. And as you can see, tech has been outperforming pretty much every quarter since 2008. I mean, staggering outperformance, to the point that no one really questions this anymore. So no one asks why technology is doing well. Everyone just assumes that's what tech does. That's quite a big assumption to make, because this period here, before the beginning of the chart, technology was dreadful, absolutely awful, massive underperformance, not attractive at all. And we don't know what's going to happen next. So what is it that's caused this extraordinary outperformance, 15 years or so outperformance? What's going on here? And when you look at it, the immediate reason for it is actually much more obvious than you would expect. It's essentially this chart here. So this is the incremental operating profit of the S&P 500. So this is all the additional profits earned by all US listed companies, large cap listed companies, since the end of 2009, divided into technology in blue and everything else in grey. And what you immediately see is the grey, the vast majority of the US listed market, has seen saw no profit growth whatsoever in that 11-year period. And that's absolutely staggering. And in that time, technology grew its profits by 12% a year. So that immediately explains why technology outperformed around that period, because it's responsible for all the profit growth in the entire US equity market for an 11-year period. But this raises two additional questions. The first one is, why is this happening? Because this is absolutely extraordinary. That just should never happen. And the second question is, will it continue? Because if this continues, then technology continues to outperform the rest of the market. And the reason this is happening, in our view, is a change that happened back here in around 2005 and really got going through this period, a fundamental change in the way that technology operates. And rather surprisingly, no one is paying any attention to this whatsoever. And it's illustrated by these two images. These are both of the same place. This is a bridge in Berlin at the same time, early on a Sunday morning. And you can see from Google on the left that there is heavy traffic on that bridge because it's colored lit dark red, probably stationary traffic. You can see from the photograph, apparently there are no cars here at all, no vehicles at all. So what's going on? How does Google generate this traffic information? And why was it not working on this occasion? So are the people standing on top of this building over here watching the traffic and phoning the office to say what's going on? Clearly not. That's completely impractical. But maybe there are cameras on these lampposts. And outside Berlin, there's an enormous building with screens that show every street in the city, and people are watching those screens and deciding whether to color the roads green, yellow, or red. But again, actually, that's impractical at scale. You can't achieve it. You can't run a business like that at scale. So Google uses a completely different approach that was perfected by Vodafone and TomTom in around 2005. They follow the movement of mobile phones. And if lots of mobile phones are traveling down a road at more than a walking speed, and then they all begin to slow down and come to a halt in roughly the same place, then Google assumes that those phones are all in vehicles. And there's heavy and then stationary traffic. So it colors the road green and then yellow and then red. And that works very well most of the time. Now, it's not working on this occasion because this gentleman here is a performance artist, and in his trolley, he has 99 mobile phones, all of which are switched on. So Google thinks there's a lot of vehicles going very slowly across the bridge, so it's colored it red entirely logically. Now, if there had been people watching from the top of this building or through cameras on these lampposts, they'd see through this immediately. But there aren't any humans. The humans have been completely removed from the system. And that is the fundamental change in technology in the last 20 years. This is what technology looked like in the 20th century. You have a digital computer. It doesn't understand the analog world that we live in, a world of continuous variables. So it needs a human being to translate, to take an analog problem and translate it into a digital question the computer can understand. And normally we do that with a keyboard nowadays. And the machine will then do something very impressive and exciting and clever in the middle and produce a digital output on a screen, on a printout. A human being would read that, and then we humans would act on the world. So we were the input and output device for the system. We translated analog to digital, then digital to analog, and then we acted. But from around 2005, that began to change because the computer started to come out of its box and interact directly with the real world. And we moved to this much simpler model. So the computer now has sensors, analog, mixed signal semiconductors, things that tell it what's going on. It now knows something directly about the real world. It's a very limited aspect that it knows about, but there's no one with a keyboard putting the information in anymore. And at the other end, automation and robotics, the system is no longer just suggesting what we do next. The machine is doing it directly. The computer is changing the world itself. And this is a really fundamental change, because we humans have set this system up, but now we step back and we supervise. And we've taken ourselves out of the loop. And if you take the human being out of the loop, then processes run millions of times faster because we were by far the slowest bit of that system. And if processes can run millions of times faster, then hundreds of times more applications become possible. Things that were simply impossible in 2000 are now just very difficult. And the tech sector is all about very difficult. That's what the sector does. So another couple of quick examples. If you were bought a Nintendo Wii when it came out in 2006, you had a completely new gameplay experience. Up until then, any games console you were playing with, you held a controller in your hands with two levers and lots of little buttons. And you used those levers and those buttons to interpret your intentions on the screen. But with the Wii, if you wanted to play tennis, you just picked up the controller and you swung it like a tennis racket. Completely new way of playing games on the TV with a console. And the reason that the Wii, the cheapest and simplest of the three consoles at the time, could do this was because it knew something about the world. It knew exactly where that controller was, how it was oriented, and which direction it was traveling in. And that was enough for you to put topspin or backspin on the tennis ball. So a really fundamentally different way of playing a game. Or with Uber. What's the fundamental difference between Uber and every preceding taxi service? So with a traditional taxi, you're in a restaurant and you want to lift home. So you phone the taxi office. The lady with the headset takes you a call. She finds out where you are and where you want to go. She contacts the driver. How long will it take for him to get to you? What should they charge you? She phones you back and the service starts. With Uber, it's completely different because you have a mobile phone that knows precisely where you are and you tell it where you want to go. And the driver has a mobile phone that knows exactly where he is. And that's it. That's all the information the system requires. There's no one with a headset on anymore. The human being has been completely removed from the system. And that is the fundamental difference between Uber and every preceding taxi service. Now, there's an enormous amount going on in technology at the moment. We're not imagining it. There is more changing at the moment than in any lifetime before us. And the reason it's all happening now is because this single block, this bottleneck in technology in every aspect of our lives, the human being in the loop, has been removed from everything at the same time. So things that were simply impossible are now possible. And we're working through the range of those possibilities. And it's going to take a very long time to get to the end of that. So at the same moment, everything is moving very fast in every aspect of our lives, our personal lives, business, government, military, healthcare, whatever it is. Technology is changing very, very fast because systems have suddenly become directly connected to the real world, and that enables things that were not previously possible. And the impact of that economically is quite dramatic, because it means that technology has suddenly gone from being an industry vertical like all the others to an economic horizontal. In every other industry, the company that is winning is the one that's worked out how to use technology in a new way to turn that business upside down. Its competitors then have to copy it, or they'll go out of business. And from then on, that new disruptive application becomes a cost of doing business for all of them. So now every company in every other industry is having to spend as much money as it possibly can on technology, because that's how you survive, that's how you win. So they're spending their excess returns, their profits, on tech. But if you don't reinvest your excess returns in your own business, your business doesn't grow. And that's what was happening back here. The grey, the non-tech companies, are having to invest all of their excess returns in the blue, in technology. So the only bit of the market that can grow is technology. And it's not going to stop anytime soon. Because every time you have a new application that's enabled by direct connection, it may enable a range of further applications. And each of those may enable further applications again and again and again and again. So you have first order effects, second, third, fourth, fifth, wave after wave after wave of change. And it just takes a very long time to get to the end of that. So the big changes in technology take decades to work their way to a conclusion, and we are nowhere near the end of that. At the moment, if anything, it seems as though it's trying to accelerate, not decelerate. So what can we use that for as an investor? So I now understand there's a common factor underlying everything that's going on in technology. And I'm also confident it's going to go on for a very, very long time. So that gives me an enormous advantage as an investor. Everybody else is chasing one hot theme after another, constantly changing their positions, trying to get the latest hot story into their portfolios. And that one there is probably Metaverse. And this one's ChatGPT. And we don't know what this one down here is yet. That's next year's story. But we recognize that all of these are either aspects of or enabled by direct connection. So that's what we focus on. We focus on the companies that make all of this disruption possible. And the amazing thing is that those companies don't change, that the same businesses again and again and again. So not only do they give us exposure to whatever is exciting and growing fast in tech today, but also whatever comes next. Because this technology story of next year that none of us have yet heard about, in San Francisco, there's a company that's making that happen now. But in order to make it work, they have to connect their systems to the real world. So they're buying stuff from our companies already, and we've never even heard of them. And that's a massive advantage, because my competitors are spending all their time trying to work out what comes next. And we simply don't care, because we already own the beneficiaries. The business comes to us, we don't have to go and get it. And that really brings us on to the next bit of the story. How do you play this change? Technologies are going so fast, changing so fast, driving so much growth because of direct connection. So what is the best way of playing that as an investor? So here's an example of last year's disruptive technology. Generative AI. So each of these little companies on the right, each of these logos is a business that received at least $5 million of funding for generative AI in the first quarter of last year. So just as the story was really getting going. And the companies in the right-hand column, each of those received more than $100 million. And there are 37 names in that right-hand column on its own. So that's $3.7 billion at least. There's probably 30 or $40 billion of funding on this page altogether, something like that. And that's in one quarter, so maybe 100 million last year. That's an absolutely enormous amount of money. So the entire capital budget, capital expenditure of the world semiconductor industry the year before last, which was the peak year ever, was $96 billion. So this is on a similar order of magnitude, very similar number possible. And almost all of this money is being wasted. So of these companies on this page, there's probably 200 or 300 companies in that grid. All but 2 or 3 of them will go bankrupt. Those 2 or 3 will change the world, but the rest of them will go bankrupt or fade away or be acquired for nothing or merge or pivot, or you just won't hear about them anymore. So the vast majority of this spend is being wasted. My competitors are spending all their time trying to pick the 2 or 3 winners from that page. And that's very hard to pick 2 or 3 winners from 200 or 300 potential players. How are you going to know? And even worse, you don't know if you're right for 10 or 15 years, because none of these companies are going to make any money for 10 or 15 years, if they ever do. So that is not only hard, but you also have to be incredibly patient to work out whether you're correct or not. And that's not what we're interested in doing. So I would not recommend doing that. That's what everyone else is trying to do. And it is a complete waste of time as an investor. What we think about is, where is all that money going? Because all that money is being spent on exactly the same thing. And that's because generative AI is incredibly computer intensive. It involves vast amounts of computing power. So almost all of that money is being spent on computing power. And we own the companies that sell that computing power. And the obvious one, the most obvious one, just because it's obvious doesn't mean it's wrong, is NVIDIA. So NVIDIA is the most leveraged, the most immediately leveraged company in the world to this story. And that's because it's basically a mix shift within its business. Traditionally, NVIDIA, which doesn't make anything, it basically pays TSMC to make chips for it. It basically pays TSMC to make graphics cards. So each of these is a $100 graphics card that is sold to a PC gamer to accelerate the graphics on their machine. And so in this area of silicon that TSMC is manufacturing for NVIDIA, it can fit, let's say, 16 of these graphics cards. So that's $1,600 of revenue. 6% gross margin gives you $1,000 of gross profit for that area of silicon. But at the moment, it can sell generative AI processors, which are much bigger. So let's say 4 on the same area as those 16, but each of them will sell for $20,000 to $40,000 a piece currently. So the revenue from this area of silicon is now $80,000. So it's gone from $1,600 to $80,000, but the cost is almost unchanged. So the profit from this area of silicon has gone from around $1,000 to around $80,000. So unit volumes have gone down by 75% because these chips are much bigger. But the gross profit earned on that bit of silicon has gone up by a factor of 80. That's really dramatic. Now, it can't move its entire business from the left to the right. And the business on the left is very good. The business on the right is absolutely incredible. So it's a mix shift from part of this business from the left to the right. And the impact of that on its economics is spectacular. So the top chart, the white line, are the estimated earnings per share for the year that will end at the end of this month. So the current fiscal year. And the blue line is next fiscal year. And as you can see, back in May, the white line, so the expectations for the year that's just about to end now, was around $4.50. And that's gone up to $12.31. And the blue line has gone up to $20.44. And over time, of course, we're moving from the white line to the blue line. So if you look back a year and you go here, you say the next year's earnings are going to be roughly $4.30. And now we get to here, and the next year's earnings are roughly $20.44. So that's more than quadrupled. So the expectations for the next 12 months' earnings have gone up by more than a factor of 4 in a 12-month period. Now the stock, the white line here, the stock price has done extremely well. It was up 240% last year, but only 240%. And earnings estimates were up by fourfold. With the result that if you value this company at a forward multiple, which is how you should value a company like this, NVIDIA, its forward estimates, or its forward multiple has collapsed, basically. It got down to around 20, back up to about 26 times next year now, which is pretty much the lowest it's been in the last 5 years. And it's pretty cheap for this sort of business. I mean, there's all sorts of problems in NVIDIA, and I'm not saying you have to go out and buy NVIDIA at all, but anybody who says NVIDIA is expensive is simply not doing the maths correctly. They just don't know what they're talking about. Because on the face of it, the PE multiple, the forward PE multiple of this company is pretty much at a 5-year low, and it's 26 times for a company that is seeing explosive growth of profits, not just revenue, but profits. So why is it trading at such a low forward multiple? And that's because this is a generative AI story, and everybody knows from their own experience that tech stories don't last very long. You get a couple of good years, and then everyone moves on to the next one, and the good stocks from that old story get left behind. And they collapse, maybe slowly, maybe gracefully, maybe very fast. But people are saying, these earnings, okay, they're growing very fast, but it's not going to last. This is a generative AI story, so it's a 1 year, 2 year wonder. So we're only going to pay 26 times next year's earnings for it. And that is complete rubbish. So this chart is very simple. It's on a log scale, so that blue line is actually seeing an acceleration in the annual revenue of NVIDIA. So that's the last 15 years of revenue for this business. And at the moment, it's the best play on generative AI. recently it was a pretty good play on the metaverse. It was the only liquid play on Bitcoin mining. It's a very good play on training machine learning. It was a very good play on autonomous driving. It was a pretty good play on virtual reality. It was pretty much the only decent play on big data. And these are pretty much the 7 big themes of technology in the last 15 years. And NVIDIA was either one of the better or pretty much the only good liquid play on that theme. And that's because NVIDIA is not a generative AI story. NVIDIA is a story on processing vast amounts of data very fast. So you've got lots and lots of little bits of data, and you need to process enormous quantities very fast. You don't use a sequential processor from Intel, because an Intel processor basically solves one problem, then does another calculation, then another one, then another, very fast, but one at a time, or 4 at a time, or possibly 8 at a time. An NVIDIA chip does thousands of simultaneous calculations because that's what you need for high quality graphics. So if you want to churn a lot of data very fast, you don't use an Intel processor, use an NVIDIA processor. And NVIDIA is by far the leader in this space, and it's also got a lock on the programming language, CUDA, which people use for manipulating big data. So NVIDIA isn't a generative AI story. It's a processing lots of data very fast story. And we don't know what next year's tech story is going to be. We don't know yet. But when it arrives, I'm pretty certain it'll involve processing a very large amount of data very fast. So NVIDIA may not be the best play on it, but it will be a very good one. So that blue line will keep on going up and to the right. It might not go on accelerating, but it will keep on going up and to the right very fast. And that makes NVIDIA at the moment look surprisingly cheap, because this is a story that's not just going to fade away after a year. There's all sorts of problems with NVIDIA. I'm not saying it's the perfect stock, but people are misunderstanding what it is. It isn't a generative AI story. It's a processing big data story. And almost anything we want to do at the moment involves processing large amounts of big data. So NVIDIA will be involved. So let's have a look at another example of an industry that's being disrupted. So the blue line, the total advertising revenue dollars of the entire US newspaper industry in constant 2012 dollars. So as you can see, for a long time, this was a very decent growth industry. And then the internet came along and the advertising market collapsed for newspapers. But if you take the 2012 revenue of Google and you add it back in, which is this blue bar, you get to that point there, which is almost perfectly continuing the trend. So basically you have an entire industry's revenue has been transferred to one company, to Google. So you have the disruptor, Google, stealing the revenue from the entire industry. And that's what's going on in all sorts of different areas. And in this case, it's a single company, because Google is effectively a monopoly. So not only has it stolen the revenue, it's also stolen the profits. So Google is extremely profitable, more profitable than these newspaper companies were, because it's got no competition. So not only has it stolen the revenue, it's also stolen the profits from this business. But that's quite unusual, because in most cases, there isn't just one disruptor, but lots of them, thousands of them. If you think about fintech, the banks used to have 2 types of business. They used to have profitable, low capital intensity business and less profitable, higher capital intensity business. And all the first lot has been stolen by the fintechs. But so the banks are now very unattractive businesses, because they're left with basically the high capital intensity, low margin business. It's not a decent business anymore. But the fintechs have then competed that profit away. So they've taken the revenue, but they've lost all the profits. Show me a fintech that makes a profit, and you show me a very, very rare creature indeed. Almost none of them are profitable, because they're competing away those profits very fast. So in that case, the fintechs have stolen the revenue, but they've lost the profit on the way through. And that is a much more common story for disruptors. So the fintechs here are the disruptors, the banks, and the incumbents. So disruptors, the companies that are exciting, that are changing the world, that everybody's using and seeing, disruptors don't make money. They're companies that spend money. These are businesses that spend huge amounts of money on technology to grow very fast, to make life difficult for everybody else. And then even worse, they disrupt once, and then someone else disrupts them. So they're really not very attractive as investments, in my view. In contrast, the enablers, the technology companies that make all of this disruption possible, like NVIDIA and lots of other businesses that we own and follow, the enablers are the companies that make the money, because this is where the money is being spent. This is where the profits are being made. And then the nice thing is, because you enable one disruption after another, those profits can grow year after year. So these are very attractive investments, because enablers are very profitable, and those profits can outgrow the market for many, many years. In contrast, the disruptors don't make money and then they die. So why would you even bother looking at them? And yet my competitors spend 95% of their time on this group here, the disruptors, because they're exciting. And people think that you have to have exciting stocks in technology funds. And actually, the last thing you want to own as an investor is excitement. Let's demonstrate this with another. You may not believe my profit chart earlier on, but here's the Goldman Sachs version of the same chart. So presumably it's true. The pale blue line are the total profits of all large cap US technology companies added together. And the dark blue line are the total profits of all the world's large cap non-technology companies. And what you immediately see is those non-tech companies have effectively seen no profit growth at all since 2007. So it's now almost 17 years without profit growth. While the tech companies have grown their profits by 900% over the same period. So where are Google and Facebook and Uber and Tesla in this chart? Are they technology companies? No, because they don't sell technology, they buy technology. They're not defined as technology companies. These businesses, the tech companies, sell 5 things. They sell hardware, software, semiconductors, IT services, or networking equipment. And if you sell anything else, you're not a technology company, you're a consumer of technology, and you're in the dark blue line. So this dark blue line includes all the exciting disruptors, even Google and Facebook, 2 of the biggest, most profitable companies in the world. And yet this line still hasn't gone up, it's just gone sideways. Because whatever is going on here is a series of zero-sum games. There are individual winners, but they are balanced by individual losers. And that makes investing in that space very hard because you've got to pick the winners and you've got to go on changing to find the new winner and get out before they stop being winners. Instead, what you should just do is buy the pale blue line because these companies are basically fueling all this stuff going on here. And the profit growth from the rest of the market is being transferred to the tech sector. And that's what you should play. You should just stay in these companies here. But however good this story I'm telling you is, tech has done so well, as we saw at the beginning, that there must have been a tech bubble a couple of years. And maybe we just reinflated it in the last year. So let's have a look not at a market cap weighted index, as we would normally use, as I used at the beginning, but an equal weighted one, because technology is so dominated by the mega caps that that they distort the performance over time. So this is the equal weighted S&P tech index. This is the performance of the average US large cap tech stock. And it's on a log scale. So these red lines are 15.2% annual growth all the way along. So that's constant growth, that 15% line. And this is the most amazing chart I've ever seen in my life. It's absolutely phenomenal. This shows that US tech stocks, the average US tech stock, has been going up by 15% a year every single year since 2009. So that's now 15 years without fail. And if you do anything with a 15% growth for 15 years, by the end of it, surely it must be too expensive. There must be a bubble. But now I take you back to this chart. And the slope of this line is 15%. It's exactly the same slope. So the average US tech stock has seen its stock price go up by 15% a year, every year, since 2009, because its profits have gone up by 15% a year. Why have these companies gone up? Because they have a lot collectively. So there was a bubble in equities 2 years ago. And it was in everything apart from the tech sector, because in the dark blue line, you have disruptors, most of whom will never make any money, and they're all grossly overvalued. And you also have the companies that are disrupting, the incumbents, some of which have no valid business model anymore. So they're not worth anything. And yet, collectively, they saw substantial increase in value over those 17 years without any profit growth at all to talk about. And that was a bubble. And that's what's been deflating for the last couple of years. So let's just think about revenue growth for a moment. So lots of time is spent on finding businesses which are growing that top line very, very fast indeed. People love 100%, 200%, 300% revenue growth. As an investor, it's not a good idea for 4 reasons. The first reason is that growth rate will slow down at some point. It's very difficult to predict when that happens. And when it does, the stock will fall like a stone. So it's just very risky investing in these companies. The second point is that companies that are built for high revenue growth are not built for profit. So take WeWork as an extreme example. WeWork was run from day one with a single aim, and that was to grow its revenue as fast as it possibly could, because that's how you attract venture capital money. And for a startup, that's entirely logical. Don't worry about profits, just grow the top line and hope the money comes in time. And it was very successful. It grew revenue extremely fast. It brought in a lot of money, and then it forgot to grow up and become profitable. And the reason it forgot was at the very moment the management was trying to work out how to make money from this business, SoftBank's Vision Fund came along and said, here's another $4 billion, but you can only have it if you promise that every decision you make from now on maximizes revenue growth, whatever the cost. So they made some really stupid decisions from an economic point of view. And once you run a company like that for a few years, it's almost impossible to turn it into an inherently profitable business. So WeWork failed to IPO under the original management for very good reason, because it wasn't a business, it was a charity basically for tenants. It had the previous management, the founders thrown out very expensively, and professional managers put in. And yet, 4 years later, it still went bankrupt. There was nothing they could do. It was a business that was not designed to make a profit. It was just designed to grow revenue very fast. And that can only go on for so long. The third point is extremely simple. Outlier revenue growth are extremely obvious. We can screen for them on Bloomberg and every other system. So they're just too obvious. Everyone knows who they are. So they're far too expensive. But the fourth point as an investor is the best. There are always more of these companies going down than going up. So back in 2020, Tesla started the year as a very, very big stock indeed. And it was an amazing performer. And we didn't own it in the Blue Box Technology Fund, and we didn't care. And we outperformed by 19%. Top performing tech funds in the world for 2020, without owning the big winner, or any of the big winners for that matter. Everybody says you can't outperform the market if you haven't got the big winners. It's complete rubbish, because we didn't own the big winner from the year before, and 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 all of those are going down. But no one talks about the stocks that are going down. They only talk about the stocks that are going up because they're exciting. So you don't get the full impression of how many of these companies are underperforming all the time in the background. If you own none of this type of company, you are already ahead of your benchmark and all your competitors, and you haven't even got out of bed yet. It's fantastic. These companies are not worth investing in, so we ignore them. The next question is, do companies need to make a profit? And there's a sort of general view now that tech companies don't need to make a profit. They can promise a profit in 15, 20, 30 years' time, but they don't need to make a profit at the moment. And we just don't agree with that. So we want to invest in companies with these four characteristics. First of all, a strong underlying technology trend. Second, can it create economic value? So that's profits, free cash flow from that trend. Third one is barriers to entry, or someone's going to steal those profits away. And then number four, who owns the profits once they've been made? Does a reasonable proportion belong to outside shareholders, because they're our clients, they're the ones that matter to us. And that's the most boring list you've ever seen. I suspect you've all had to study this in CFA level 1. This is what everyone's looking for in every sector, these four things. Apart from the tech sector, because tech investors are only interested in number 1 and number 3. So tech investors are obsessed with number 1, top line growth, and number 3, product, competitive strength, the barriers to entry. And when they find a company that's growing its revenue very fast with a great product, they just buy it and assume it's going to outperform. And I'm afraid usually it doesn't. And that's normally because of number 2, they haven't thought about, can this company actually ever make any money with this product? And number 4, who owns the money once it's been made, is no longer even regarded as a valid question in the technology sector. So this is really very odd, because these are the 4 rules of investment. They're exactly the same in the technology sector as in every other sector, and yet everybody is ignoring 2 of them, which is absolutely weird. But the reason this is happening is there is a misunderstanding of what the job of a technology investor is. People think that the job of a technology investor is to invest in technology, but I'm afraid it's not. It's pretty clear. The job of a technology investor is to invest in technology companies, and a company has to create value for its outside investors at some point in its history, or it's worth nothing. Nothing at all. It never was worth anything. It never will be worth anything. You might be able to buy it and sell it for a profit on the way through, but that's very difficult to do it consistently. It's largely a matter of luck. And yet that's what everybody else is trying to do. Everyone else is essentially trying to do the same thing. They're taking other people's money from their clients, and they're using it to buy stakes in businesses which are fundamentally worth nothing, but they hope to sell them for a profit before anybody else notices they're worth nothing. And that doesn't work very well. What we're doing is completely different. We're taking other people's money from our investors, and we're using it to buy stakes in businesses which are very profitable today. So they're worth a lot of money as they are today, and where we're convinced those profits will outgrow the market for many, many years to come. So this should outperform. And that works very well indeed. So number 4, I just touched on very briefly, but where does the value go? Who owns the value if it's not the people who own the company? And in tech, I'm not going to go into these in detail, but this is where value goes in tech. So massive stock compensation anywhere around Northern California. Absolutely absurd. Multiples of the value that's been created by the business every year because the scarce resource is not the investors, it's the engineers. And the engineers love options. And we tell management you can use as many options as you like. So they massively overuse them. Acquisitions. So absurdly overpriced acquisitions because no one in tech worries about price. There's no incentive to argue the price down if you're the buyer. Lack of accountability, some non-voting or super voting shares or self-appointing boards like Alibaba's. This business is not being run for shareholders, it's being run for someone else, management. Lack of business focus. So companies that focus on revenue growth, which we talked about, or tech leadership. So tech leadership is very different. This is where the founder, who's an engineer, is running a business. Founders are amazing people. They think differently from the rest of us. One of the things they think differently about is what is the purpose of business? And the purpose of a business for an engineer is not to make a profit, it's to make the best possible product. So that's what they do. It's a business that's not designed to make profits, but to make products. And that's different. It's not what we want to work. And the final one is restructuring. So here you have a company which basically is very profitable every year, but every couple of years it has a huge restructuring expense, and everyone just ignores that because it's a one-off, it's a restructuring. So you can pro forma it out. And yet, if it happens every other year, it's quite clearly not a one-off. It's just a cost of doing business. So you've got to keep it in the numbers. You might split it between 2 or 3 years, but it's a cost of running the business. And the nice thing is that all of these 5 appear in the same place. They all appear in the adjustment, the pro forma adjustment to earnings and EPS. So if you want to see what's wrong with a business, what people don't want you to think about it, you just go to Bloomberg and you look up the pro forma adjustments. And there you have a list of everything that's wrong with that business in numerical order, from the biggest to the smallest. And that's what you should focus on, because that's what no one wants you to think about. So don't worry about excitement. That's a waste of time. You want to find businesses that are being run for outside shareholders. And actually, most of the exciting ones aren't. So here are the 4 points. Why has technology been doing so well? Because direct connection is unlocking huge numbers of new applications in every aspect of our lives. How should you play it? Through the enablers, the technology companies, not the disruptors, the companies that are buying technology and doing something exciting with it. You don't want excitement as an investor. What about explosive revenue growth? Ignore it. It's a distraction. It's not a good thing to invest in. And then finally, do companies need to make profits? Yes, at some point, fairly soon, all they're worth, nothing. And the market has become, in the last 3 years, a little bit more discerning. After a gross misallocation of capital from about 2011 to 2021, you've had the market working out what's going on for the moment. So the blue line is our fund. These are profitable technology enablers. The red line is Cathie Wood, ARK Innovation Active ETF. Nothing wrong with Cathie, but what she owns are basically loss-making, negative PE on this fund, disruptors, because very few of our stocks are tech companies. So most companies are using tech to disrupt other industries, fintech, healthcare tech, industrial tech, consumer tech, media tech, all that sort of stuff. So the red line are loss-making disruptors. We both had a very, very good 2020. She had an amazing 2020, but essentially the correlation between the red and the blue line in 2020 was near perfect. She just had a beta of 2 to us. And then that correlation completely broke down almost 3 years ago in February 2021. And the market has been working out it's not interested in loss-making companies. So they're basically down massively over that period. Our stocks, the profitable tech companies, carried on going up. They went down last year for 9 months because people were worried about the economy. And then in October last year, year before last now, 2022, October 2022, basically a mild US recession was priced in. That's probably still the most likely outcome. And the tech sector can then recover. And that was the cyclical bottom. When we're into the next bull market now, we had a new all-time high at that point now, and it will continue, in my view, on 15% plus for a very long time to go. So that is a cyclical decline and recovery. That is a structural decline, and it doesn't have to recover at all. Now, one day, this style of company will come back into fashion, but it'll be the hot stocks of the day then in 5, 10, 15 years' time. It won't be the same companies. So that basically is, I think, pretty much all I had to talk about. So I've got a couple more slides, but I'll only use them if required for questions. So time for questions, I think. Feel free to put a question in the comments or something of that sort if you like, or stick your hand up and we can unmute you or whatever. Hopefully, lots of people madly typing away in the background. So we'll just have a pause here while everybody types. Make sure you all come at once. Or else
So
everyone's.
if there's no questions, so thank you, William, for the presentation. Very interesting as usual. And okay, we
one
have
question.
one question.
So could you explain in further detail the concept of direct connection? So what it's really doing is saying the computers now can work out what's going on for themselves. They don't need someone with keyboards to put the information in anymore. So you guys are probably all too young to have remember when the first iPhone came out, but this is an iPhone, okay? We all got them now, all smartphones. And one of the most amazing things about an iPhone when we first got them was if you did that. It seems obvious now, but basically everything moved from portrait to landscape automatically as the phone was turned around. Now, if you'd had a Nokia phone in 2006 and you wanted to move from portrait to landscape to look at a photograph, you could do it. But you'd have to put up menu, then you'd have display or settings, then display, then orientation. You'd flip between portrait and landscape and you do exit, 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 and now you can turn your phone around. Whereas the iPhone, you just do that. Because the iPhone knows something about the world. It knows which way up it is. Very simple. It's tiny. But it's really dramatic because suddenly you can do all sorts of stuff. I mean, these phones have got all sorts of compasses, accelerators, GPSs, thermometers. You know, if you've got a watch, it'll take your blood pressure and all sorts of other stuff and the color of your blood. All these things are basically measured automatically. I don't have to take my pulse. The Apple Watch will do it for me. You know, and this is on a very small scale. But actually, in every aspect of our lives, this is happening. And it's enabling applications that never existed before. So until you had a phone that did that with a decent touchscreen, all the apps on that phone couldn't be created. Not a single one of them would have worked on a Nokia phone, almost without exception. And suddenly they can, because you've got a touchscreen phone that knows which way up it is. And that just changes everything. And that's what I mean. Every time you have one of these changes, it can create lots of further applications. And each of those applications can then create further applications again. It just takes a long, long, long time. Okay, next one. What do you estimate will be the negative impact of disruptors to enablers, since eventually the enablers depend on the disruptors' spending? Yes, so the enablers do depend on the disruptor spending, but also the incumbent spending. So it's not just the disruptors who are spending money, it's also the companies defending themselves against disruption. So if we think about video streaming, who's the biggest spender in the world on video streaming? Is it the disruptor, Netflix? No, it's Disney, with Disney Plus. Because Disney has the biggest balance sheet and it has everything to lose. So Disney will spend whatever it takes to defeat Netflix. So more money is being spent by Disney and all the other existing channels than it is by Netflix. And even if Netflix disappeared tomorrow, all those other companies are going to have to keep on spending because now the game is video streaming. It's not, you know, linear broadcast television anymore. So they're going to have to spend on streaming. So even if you take the disruptors away, the spend continues. Now, if you have fewer disruptors, it may well be that after a while you do get less disruption. But I'm not sure that's the case, actually. I don't think that would slow down the industry because that extraordinarily steady chart that I showed you earlier on of the equal weighted S&P Tech Index at 15% a year, every single year. But I'll put it back up because it's such a good chart. I can't resist putting this one back up again. So let's get this back on the screen again. So here it is. I meant to say this while I was going along. So why is this line going up at 15% a year? Is it because there's exactly 15% more demand for technology because there's exactly 15% more disruption every year? It seems very unlikely. That would be an amazing coincidence. The reason this line is going up at such a steady rate is it's constrained not by demand, but by supply. This is an industry that can only grow at 15% a year. And in 2020, we did a natural experiment to see if we can make it grow faster. So we had a huge epidemic. And in order to keep our societies going, we needed to buy a lot more technology very suddenly. So we forced this industry to go faster than 15%. And we made it grow up here at a faster rate. And the result of that has been 2 years of global inflation. And we're now right back in the middle of that trend again. So basically, it's pretty resilient. I think there is, in effect, infinite demand for technology at the moment. But the industry can only grow at 15% a year, supply constrained. And the nice thing, from my point of view, is the biggest supply constraints are my companies. that gives me huge confidence so that I can buy the dip there in October 2018. I can buy the dip in March 2020. I can buy the dip in October 2022, because in the long run, I know this will save me. And with a 15% growth trend, the long run doesn't take very long to come along. You know, there is no point on this chart where you've not made money in 3 years, and there's almost no points where you've not made money in about 18 months. So don't worry about timing tech. It's a complete waste of time. We still have investors who started looking at our fund and liked it back in 2018, and they're still waiting to buy. They're still waiting for the buying opportunity, and they've missed it there and there and there and there. Despite the fact we told them at the time, you know, actually, it's probably not going to get a lot worse. Maybe you'd like to invest. They still don't, because they're frightened of investing at that point. So don't wait for the dip, because the dip will almost certainly be higher than it is today. And even if it isn't, in a couple of years, it won't make any difference. I can't remember what the question was, but hopefully that answered it. Right. So crystal clear, excellent, good. You talked about stock-based compensation in the innovative companies, but NVIDIA and the rest of the enablers companies also have huge stock-based comps, and the adjusted multiple is much higher than what Bloomberg showed. Well, NVIDIA isn't an enormous offender on that basis. So nothing like as much as cloud software companies. So the really big ones here are cloud software and internet companies that are based within a few miles of San Francisco. And I've got a chart. I haven't got it up, I'm afraid, today, but basically plotting the number of years of free cash flow that are required to keep the stock count flat in any 1 year on a log scale against the distance to the Golden Gate Bridge to the company headquarters, and it's an almost perfect correlation. So it's very geographically constrained. Now, NVIDIA is a California business, although it's San Diego, isn't it, rather than Northern California, I think. But its stock comp is material, but it doesn't destroy the business model like the others. And if that's what you need to run the business, that's fine. But you need to look at GAAP earnings. So we want our own companies. We want to own companies that are growing their GAAP earnings per share at 15% or more, preferably a lot more than that, year after year for many, many years to come. And NVIDIA makes that easily, no problem at all. Do you consider that the return from the multiple expansion is sustainable? What do you think the returns of the technology index could be for the next 15 years? Well, that's sort of the point. So there wasn't any multiple expansion. So because this 15% growth rate is exactly the same as that 15% growth rate. So these are the earnings, and that's the stock price. So the PE has essentially remained the same. So if you look at the 5-year growth of our share of the profits of all the companies we own, so the 5-year growth of that is 18.7% at the moment. I calculated it yesterday, and the performance of the fund since inception is 19.1%. So effectively the same number, both of them around to 19%. So these stocks have gone up by 19% in the last almost 6 years because their profits have gone up by 19% in almost the last 6 years. And that's enough to put you ahead of the benchmark and almost every competitor in the world. So of all, according to Bloomberg, of all offshore global technology funds in the 5 years to the end of December, we are the number one over that period. There's one fund that's above us, but it's a rather obscure Liechtenstein blockchain fund, so I don't really know what's going on there. We've beaten every other global technology fund over that period. So I don't think there has been multiple expansion. The multiple expansion was in the non-tech companies, the disruptors, the companies that are being disrupted. That's why you saw multiple expansion, and that's what's been unwinding over the last few years. I've spoken about technology enablers and their historic growth success. Do you anticipate a source of strong growth, value creation in the coming years to be those companies enabling others to decarbonize, reducing their polluting activities to address the climate and biodiversity and emergency? Yes, well, that's clearly a driver. So most of the solutions to ESG issues, or particularly the E's and the S's, are technology-based. So, and that just adds another disruptor. So imagine, we've all seen this, a pyramid of champagne glasses. So you have a single champagne glass at the top, and you have 4 in the row before, and then 16 below that. And by the bottom, a couple of those rows down, you've got thousands of champagne glasses. And into the top champagne glass, you pour an awful lot of champagne. And it overflows, and it overflows, and it overflows. But in the end, it all ends up in the glasses at the bottom. It doesn't end up on the table if you do it carefully. The technology industry is exactly the opposite of that. So the technology industry is an inverted pyramid of champagne glasses. So at the bottom, there are 4 champagne glasses. And they're called Lam Research, Applied Materials, Tokyo Electron, and ASML. And they are the principal manufacturers of semiconductor equipment. And every piece of every semiconductor in the world is basically built on equipment provided by those 4 companies. There's no way out. There is no alternative to that. And on top of those 4 champagne glasses is an enormous pyramid with all the rest of the technology industry. And on the top layer, you have all the disruptions, all the exciting applications, everything that's changing our world. So those are the top layer of glasses. But I don't mind which of those glasses the champagne is poured into, because in the end, it will end up in the 4 at the bottom. So the top layer are the disruptions, the applications, the excitement. Whatever application, whatever disruptive technology it is, it will run on technology. Whatever technology it runs on will use semiconductors. Whatever semiconductors it uses will be manufactured by those 4 companies. So essentially, if you want to be confident about getting the benefit of next year's disruption, when you don't even know what it's going to be, there's no point in trying to pick the top layer, because that's very difficult. The further down the pyramid you get, the more certainty. And when you get to the bottom layer, you've got complete certainty. There's no alternative. You will get more than your share of the benefit if you're in those 4 companies, which is why about 20% of our fund is in those semiconductor equipment companies. And the top layer includes all this ESG stuff. So lots of stuff about solving problems of pollution, solar, wind, all of this stuff involves an enormous amount of computing power. And that's money that's being paid to our businesses. Okay, I think that's it for questions. If anyone doesn't think I've answered their question properly, then please come back to me. Anyway, I hope that made sense. And of course, I'm a tech investor. I'm biased. Don't believe a word I say. This is how I do it. There's lots of other ways to invest in tech. Most of them don't work. Some of them do. But if you want to try the other ones, there's no point in living in Europe. You have to live in California. So if you want to buy exciting stories by the latest software companies, the latest internet companies, you've got to sell them before anybody else does. And in order to do that, you have to live in Silicon Valley. So don't try doing that from London or from Paris or Madrid or anywhere else, because it's impossible. You've got to live in Northern California to do that. Possibly in Shanghai, but that's a different market. And I'm not a fan of owning Chinese companies, because they're not run for shareholders, they're run for the government now. Cool.
Okay. Thank you, William. As usual, very very interesting. And any further question? William is on LinkedIn. You can contact him.
Yep.
Or you can send me an email through the CFA Institute, and we'll be happy to help. So nothing else. Have a very good evening and night. Thank you. Bye-bye.
Bye.